So we were discussing producing in the short run or producers in the short run. In our previous video, we discussed the how to organize a business in order to do the business or organization of a firms. And then we will see that how to finance the firm, the debt or the equity combination. Now in this part, we're going to focus on how to calculate the economic profit and what's the difference between accounting profit and economic profit, and also which I already explained in part one, but again we are here discussing in detail the difference between short run and long run. So let's start. So production, cost and profit, that's the topic. And we know how to produce. For any production, we need four factors, four types of inputs. One is, we call it as output from other firms are called intermediate products. Like for a bakery, the wheat is an intermediate product from the farms or a farmer. Same is the case with the car manufacturer. Tires are the input, but from the tire manufacturer. So that's an intermediate good for the car manufacturers. Input provides directly by the nature, like we need wood, we need different types of minerals which we are extracting from the nature. Inputs that are services of the labor. Then we need labor in order to produce anything. So we need some human resource to produce things. Inputs that are the services of physical capital, and we also need a physical capital to produce something. So what we need, intermediate inputs, which can be a raw material for the production with raw material. Then we need the things which we can get it from the nature, like things like one of the thing is oxygen or gas or oil, coal, and all these things that which we are getting from wood, we are getting from nature. Then we also need some land is as well. Land is also one of the things, or water and all these things. So the input that are the services of the labor that we hired labor to produce. And the fourth one is the physical capital, which can be building, factory, tools, equipments, and all these things. Now, if we want to write mathematically how the output is going to be represented, so we can use the function. Function is an equation that explains how much we produce if we use these quantities of input. And this is the form we use to represent a production function. Now, Q is the output, and output is a function of labor and capital. So this is the way that we present, like how much we produce is dependent on labor and capital. If we increase the labor and the capital, so output is going to increase. So it's a relationship they are telling us about the inputs and the output. Output is a flow concept because we measure the output over a certain period of time, like how much we produce daily, weekly, monthly, yearly. So this is a flow concept. This is not that at this moment how much you produce. That's not the way that we measure. So it's a flow concept, not a stock concept. Now, as I mentioned that firms, the main objective of forming or developing a firm or the existence of firm is to make profit. Now, profits, how to calculate profit, it varies. Like in accounting, we measure the profit in a different way, and in economics, we measure the profit in a different way. What's the difference? We're going to talk here. So when we take all the explicit cost, a cost in which the transaction is taking place. Cost involves the purchase of goods and services by the firm, and explicit includes the hiring of workers, the rental of equipment, interest paid on debt, and the purchase of intermediate inputs. So all these things that when you pay for them and get it to produce something, this is what we call it as an explicit cost of production. So explicit cost also includes the depreciation. Depreciation is again a cost which we divide the the capital cost or the cost of an asset over the useful life. So it is not fair that we charge the cost of an asset in which we purchase, in which year we purchase, but we spread. Like if you buy a car and car is going to be work for 5 years, so it is not fair that we charge the price of a car as a cost in the year in which you purchased. We have to spread this cost over a period of time. Another definition of a depreciation is that it is a cost and a wear and tear, like the assets losing value when we are using. It's not only the car, the building, the tools, the equipments, the machines, and all these things are, when we use, they lose value, and that's what we call it as a depreciation. Which does not include the market transaction. So it's not a market transaction. We are not really paying at the moment when we are calculating a depreciation, but when we paid, we recorded it as an asset, and then gradually we consume that asset over a useful life of that asset. So how do we calculate accounting profit? So accounting profit is revenue, what we are generating by selling our goods and services, minus the explicit cost. So explicit cost, we just discussed the cost of raw material, the cost of labor, and the indirect cost of all the things what we require to produce goods, plus the depreciation. These are the all explicit cost. Now, what's the difference? I just mentioned that there is a difference between economic profit and accounting profit. Economic profit is saying that we are not just taking care of the explicit cost, but we are also taking care of the implicit cost. Now, what is an implicit cost? Implicit cost is the owner's own time, which he is spending or she is spending to do the business, right? He can do somewhere else a job and earn money. So that's the one of the implicit cost is. And the owner's capital, which the owner is using, he can use this capital in any other investment and get a return on it. So that's we forego. So these are the things that we forego for doing this or investing in this business, your own, the owner's own time, the owner's capital. So if we add up the cost of these things as well, which we call it as an implicit cost, then we arrive at an economic profit. So this is the way that you can see here. Economic profit is revenue minus explicit cost plus implicit cost, right? So explicit plus implicit should be subtracted from the revenue. So we see here that economic profit can be negative as well. So if it is negative, we call it as an economic losses. If it is positive, we call it as an economic profit. Why it is important to understand here? Because when we discuss about the competitive market, most of the firms in a competitive markets are operating at zero economic profit. So why they are operating at zero economic profit? No, it makes no sense that why do we business if we are earning zero profit? No, but when we are saying zero economic profit, it doesn't mean that it is zero accounting profit. So there is a profit in which the owner is charging for its own services towards the business, and owner is also getting a reasonable returns on their capital and all these things, or a normal profit. So by this way, actually owner is happy to get all these returns, and then the profit is zero. Economic profit is zero. So here is an example, like total revenue is 2,000, and these are the explicit costs like wages and salaries, intermediate imports, rent, interest on loan, depreciation. So when we sum up all these, so the total explicit cost is 1,160. So 2,000 is the revenue, 1,160 is the explicit cost. So what is accounting profit? When we subtract, we see accounting profit is 840. Now there are certain implicit cost, and here the implicit cost is given like owner's own time 160, owner's cost of owner's capital of 1,500, which he invested in the business. So there is two types of returns he can get it from this 1,500. One is 4% risk free, 60. And 3% are risk premium, because he's taking risk to invest in that business. So that's a premium he deserves for that. So the total implicit cost is 260. 5, and in this way we see that there is an economic profit of 575. So I hope you understand the difference between accounting profit and economic profit. So now the profit maximization, when we are saying now, whenever we talk in economics about the profit, so keep it in mind, we use the word profit, but the assumption is that we are talking about the economic profit, not accounting profit. So a firm's economic profit is the difference between the total revenue each firm derives from the sale of its output and the total cost of producing that output. So we see here this pi sign is representing a profit, and how much is the profit? Total revenue minus total cost. Total cost means explicit plus implicit. Now, the last thing in this part we want to discuss is time horizon, like short run and long run. So there are two words we commonly used in economics: in short run, in long run. Now, this short run and long run is not dependent on in calendar time or in a time in a way of days or weeks or months. It is defined in a way that short run is a time period. It can be a 1 week, it can be a 6 months, it can be a 1 year, it can be a 5 year, depending upon the nature of the business. It's a short run is a time period in which the quantity of some inputs called fixed factors. For example, for a farmer, land is fixed for a short period of time. But in the long run, the farmer can lease more land or buy more land, but in the short run, it is fixed. In the short run, for manufacturers, the plant size is fixed. So that's the way that's going to work. So a fixed factor is usually an element of a capital, but it might be a land, the services of management, or even the supply of a skilled labor. That is also possible. Like a restaurant has only one skilled chef, so it's a limited. So over a short period of time to find out another expert in that cuisine is not possible. So that's way. So inputs that are not fixed can be varied in the short run are called variable factors. So there are two factors, fixed factor and variable factor. In the short run, few factors or at least a one factor is fixed factor and others are variable factors. Now, as I mentioned, the time is not fixed like 1 month, 6 months or 1 year or 5 year, but the factors are fixed. At least one of the factors is fixed for a short run. So in the long run, what is happening? Long run is the length of a time over which firms' factors of production can be varied, but its technology is fixed. So technology is fixed, but all the factors of production are variable. Farmer can buy a new land or lease a new land. Plant owner of a manufacturing company can install a new plant with a larger capacity. So this in the time period in which it is possible is called as a long run. A very long run is a time in which the technology is also changing. Like we can see during the last 10 years, the very long period is very short in the sense in a 2 or 3 years, new technologies are coming and the whole model of the business is changing. So we can say that a very long run is during the last 10, 20 years is about of a 2 years or a 3 years or 4 years in which the whole industry is revolutionized and the technology is reduced. Like we see here, the Uber and Lyft and all these firms are operating. So it's changed the taxi services industry. Uber Eats and all these things change the business model for restaurants. So these are the technological change, but these changes are not over a 20 years or 40 years. These changes are over a short period of time. And we see Airbnb change the hotel industry. So we see how that these things that is going to affect. So so one more part regarding this topic of producers in the short run, and then we complete that topic and move on to the long run, producers in the long run.